A very good afternoon, investors. You're now on KleverStock with me, Wan Izzle, and I'll be serving the midday roundup with the latest market updates from this morning up until now. We kick it off with Bursa Malaysia updates. The Malaysian stock market showed resilience in early trade today, hovering near its weekly highs as a powerful global rally sparked by United States President Donald Trump's decision to de-escalate trade tensions with Europe. The benchmark FBM-KLCI saw a minor retracement of 1.3 points to 1,715.84 at the opening bell this morning as investors paused to lock in gains from Thursday's robust advance. Now, the previous day's surge was largely attributed to a Greenland Framework Agreement between the US and NATO, which led President Trump to rescind immediate tariff threats against 8 European nations. Now, this tariff relief ripple effect reached that of Asian shores, bolstering regional risk appetite. TA Securities, they noted in its morning report that the technical indicators are strengthening, pointing toward further upside for the local benchmark. Now, the research house stated immediate resistance is capped at the October 2015 high of 1,727, with the next upside hurdle coming at 123.6% Fibonacci projection of 1,759. Now, supporting this bullish bias, Apex Research highlighted that the market is being underpinned by sustained institutional participation and robust domestic fundamentals. Now, despite potential short-term volatility from, of course, upcoming data releases, the firm expects foreign interest to remain key pillar for large-cap stocks with clear earnings visibility. Now, the ringgit also provided a supportive backdrop, breaching the 4.04 level against the US dollar earlier today, following Bank Negara Malaysia's decision to maintain interest rates at 2.75%. Now, in the blue chip segment, some mild profit taking was evident as Hong Leong Bank dropped 20 cents to 24 ringgit, and Nestle also slipped by 50 cents to 116 ringgit 50 cents. Now, Sunway Berhad also eased by about 6 cents to 5 ringgit 51 cents, even as it reaffirmed its commitment to proceed with the 11 billion ringgit takeover of IJM Corporation, despite ongoing regulatory probes into the latter. Meanwhile, NationGate Holdings emerged as the most active stock for the second consecutive day, putting on 3 cents to 1 ringgit 22 cents on a volume of 18.75 million shares. Now, the counter continues to ride a wave of investor optimism after the Inland Revenue Board (RIB) and also MACC cleared the company of irregularities following a 6-month tax and smuggling investigation. Other actively traded stocks included Capital A, which gained by 1 cent to 53 cents, and Valesto, which remained flat at 31.5 cents. Moving on to our local currency and foreign exchange, the Malaysian ringgit surged to its strongest level in 5 years against the US dollar this morning, breaching the psychological 4.02 barrier. Now, the rally was ignited by Bank Negara Malaysia's decision on Thursday to maintain the overnight policy rate, or OPR, at 2.75%. That's a move that reinforced investor confidence in the nation's policy stability amidst a volatile global backdrop. At the start of trade on Friday, this morning, the local currency was quoted at 4.0285 or 4.0440 against the US dollar, a significant appreciation from Thursday's close of 4.0370. Now, this marks the ringgit's strongest performance since January 2021. Analysts noted that the hawkish hold by the central bank, combined with a softening US dollar index, which fell to 98.287 points, has created a perfect storm for ringgit appreciation. Now, Bank Muammar Malaysia Berhad Chief Economist Dr. Muhammad Afzanizam Abdul Rashid, he attributed the surge to both domestic and international catalysts. Afzanizam said that the MPC's decision reinforces expectations of policy stability. Furthermore, market sentiment has improved significantly after US President Donald Trump adopted a more diplomatic tone regarding the Greenland territorial dispute, reducing the geopolitical risk premium that had briefly bolstered the dollar. The ringgit's ascent also coincides with a historic rally in precious metals. Spot gold prices touched an all-time high of $4,939.64 per ounce earlier today, and it's driven by the same risk-on sentiment and dollar weakness. The latest US personal consumption expenditures, or PCE, inflation data, which rose to 2.8% in December, has solidified expectations that the US Federal Reserve will keep its own interest rates unchanged next week, further narrowing the yield differential in favor of the ringgit. Now, despite the gain against the dollar, the ringgit's performance against other major currencies remained mixed. It strengthened against the Japanese yen to 2.5416, but also saw a slight easing against the British pound to 5.4381 and also the euro at 4.7347. Regionally, the ringgit outperformed the Philippine peso but traded in a narrow range against the Singapore dollar as well as the Thai baht. Looking ahead, economists suggest that if the US dollar index continues its downward trajectory toward the 95 or 97 range, the ringgit could test the 4.00 level before the end of the first quarter. Now, this would provide a significant boost to Malaysia's purchasing power as the nation gears up for the Visit Malaysia 2026 campaign. Now, for some local economic news, the Ministry of Finance, MOF, has officially reiterated that there are no immediate plans to reintroduce the Goods and Services Tax, GST, despite calls from financial experts who regard it as a more comprehensive taxation framework. In a written parliamentary reply today, the ministry stated that the current Sales and Service Tax, SST, remains the preferred tool for the government, as it allows for a more targeted and progressive approach to revenue collection without placing undue burden on the majority of Malaysians. Now, the ministry explained that reintroducing a broad-based tax like the GST requires a thorough deliberation, particularly regarding its potential impact on disposable income and the rising cost of living. The ministry said that, as mentioned by the Prime Minister previously, the government does not intend to implement the GST. This is due to many factors that require thorough deliberation, including disposable income and living costs. This stance is rooted in the government's strategy to protect the interests of the people while also ensuring fiscal sustainability during a period of economic recovery. While acknowledging the efficiency of the GST system, the MOF pointed out that the SST has been a stable fixture in Malaysia's fiscal landscape for over 4 decades. A key factor in retaining the SST is its swifter financial impact, allowing the government to realize revenue gains more quickly than the lengthy 2-year preparatory period required for a GST rollout. Now, they said that bringing back GST would require a much longer preparation period, up to 2 years, to allow companies to update their systems and also prepare for GST compliance. Now, to bolster national coffers, the government has instead focused on expanding and refining the SST framework. Effective January 1st this year, several key changes were implemented to support businesses and households. The service tax on industrial rentals and leases was reduced from 8 to 6% to lower operating costs for traders, and the annual turnover threshold for micro, small and medium enterprises, MSMEs, exempt from service tax was raised from 1 million ringgit to 1.5 million ringgit. Now, the fiscal impact of these refinements is expected to be significant. The ministry projected that SST revenue would double to 10 billion ringgit in 2026, the first full year after the expanded tax scope was implemented. This additional revenue is earmarked for critical public programs, including the Sumbangan Tunai Rahmah STR cash aid scheme, education, as well as healthcare. Now, by maintaining a narrower tax scope that excludes essential goods, the government aims to balance its revenue requirements with the welfare of the rakyat as it navigates the 13th Malaysia Plan. Continuing with more economic news updates, the Ministry of Energy Transition and Water Transformation, also known as PETRA, has clarified that Malaysia's recently signed agreement on reciprocal trade ART with the United States does not restrict the nation from procuring nuclear reactors or fuel from other global partners. In a written response to the Dewan Rakyat earlier today, the ministry emphasized that Malaysia remains free to engage with any country, including Russia or China, for its burgeoning nuclear energy sector based on technical and commercial merit. The clarification centers on Article 5.3 of the ART, which some critics feared might create an exclusive procurement loop with the US by potentially restricting purchases from certain countries. However, the ministry noted that Article 5.3 must be read in its entirety, specifically noting that its closing sentence allows for exceptions where commercial, technical, and security considerations dictate otherwise. Now, the ministry stated that there are no restrictions on Malaysia cooperating with other countries when it comes to nuclear energy, including in the areas of training, research, safety, and radiation. They added that Malaysia maintains a balanced and neutral approach to nuclear technology. The government's stance is critical as Malaysia officially incorporates nuclear power into the 13th Malaysia Plan, and the roadmap identifies nuclear energy as a vital baseload power source to support the massive energy requirements of the nation's growing data center and AI industries. Under the 13th Malaysia Plan, the government has designated My Power Corp as the nuclear energy program implementing organization to lead this transition. Now, Malaysia is currently prioritizing small modular reactors, SMRs, due to their lower capital costs and enhanced safety features, which are seen as more practical for a first-time nuclear operator. The ministry further assured that the ART signed on October 26 during the 47th ASEAN Summit does not alter the National Energy Transition Roadmap, NETR, which aims for net zero emissions by 2050. While the US-Malaysia deal secures better tariff rates for Malaysian exports, the government has maintained the necessary policy space to ensure strategic autonomy. Now, the ministry concluded that we remain committed to ensuring all nuclear-related cooperation is carried out in line with national interests and security. They also noted that a comprehensive feasibility study is currently underway to assess regulatory requirements as well as public acceptance. Well, we'll take a short break now, but don't go away. When we return, we'll come back with some corporate news developments. Welcome back to the Midday Roundup. Let's continue with some corporate news updates. Malaysia's financial sector is moving into a critical testing phase for national digitalization as 18 banking institutions have officially confirmed their participation in Phase 2 sandbox for My Digital ID integration. Now, the government, through the Ministry of Finance, revealed that this phase focuses on a new e-verification mechanism designed to authenticate user identities for opening new accounts and conducting secure real-time banking transactions. Now, the Phase 2 sandbox represents a significant leap from the initial testing phase that concluded in June 2025, while Phase 1 involved 15 institutions and focused on basic electronic Know Your Customer (eKYC) processes. Phase 2 introduced more robust security by design features. Currently, 10 of the 18 participating banks are in the midst of integration, while 2 institutions have already completed the process. The MOF expects this sandbox to conclude by March 2026, paving the way for wider national implementation. Now, the MOF stated in a written parliamentary response, the government, through My Digital ID Sdn Bhd and Bank Negara Malaysia, is responsible for implementing an integration that preserves privacy and features auditable governance. The ministry emphasized that the system does not store personal data, but acts as a verifiable platform of trust by referencing the existing government database in real time. Now, this method is expected to drastically reduce the risk of identity theft and fraud compared to traditional document-based verification. Bank Negara Malaysia is currently overseeing the technical readiness of these institutions to ensure they meet stringent audit standards and personal data compliance before the system goes live for the general public. The banking consumers, the successful rollout of My Digital ID will mean a single sign-on experience across various platforms, eliminating the need for multiple passwords while enhancing the security of high-value digital transactions. Now, the government aims for 95% of federal services to be integrated with My Digital ID by 2030. But the banking sector remains the primary benchmark for the system's resilience. Now, as the March 2026 deadline approaches, the focus remains on ensuring that even the most complex internal banking systems can seamlessly and safely interface with the National Digital Identity Framework. Up next, we've got some business updates. SolarVest Holdings Berhad, also just known as SolarVest, they're set to navigate a transformative year in 2026, with analysts pointing to a modest near-term earnings contribution of 1 million to 2 million ringgit, while maintaining a robust long-term growth trajectory. Now, the clean energy leaders is currently in the advanced stages of finalizing the engineering, procurement, construction and commissioning EPCC contract for its 20% owned 470 megawatt large-scale solar 5 or LSS5 project with Malakoff Corporation Berhad, a key pillar of its record 1.7 billion ringgit outstanding order book. Now, in a research note dated today, Maybank Investment Bank reaffirmed its buy rating on SolarVest with a target price of 3 ringgit 67 cents. Now, the brokerage highlighted that the group's profit before tax (PBT) margins for its EPCC segment are expected to remain resilient between 8 and 10%. Maybank IB also noted that we continue to like SolarVest for its leading position and as a key beneficiary of the nation's energy transition goals. They also cited the group's 30% market share in the local solar renewable energy sector. A primary focus for investors has been the recent global volatility in solar module pricing. China recently announced plans to cancel its 9% value-added tax (VAT) export rebate for photovoltaic products effective April 1st, 2026, which is expected to push global module prices towards 11 cents or 13 cents per watt. That's 11 and 13 US dollar cents. However, SolarVest has proactively mitigated this risk by locking in a 2 gigawatt solar module blanket order with its key supplier at late 2025 prices. Now, the strategic hedge is further supported by the strengthening ringgit, which provides a partial buffer against the increased export costs from China. Now, beyond large-scale solar, SolarVest is aggressively pivoting towards energy efficiency and integrated solutions. The group completed a strategic 22% acquisition in solar district cooling group Berhad, SDCG, in December 2025, a move designed to fast-track its entry into building management systems and mechanical and electrical works. Now, this allows SolarVest to cross-sell their E&E solutions to its existing commercial and industrial customer base, leveraging the newly enacted Energy Efficiency and Conservation Act, EECA. Maybank added that SolarVest has indicated that project cost impact remains manageable and reiterated its profit margins remain intact for its EPCC project pipeline. Now, the brokerage also noted that the company is evaluating the feasibility of accelerating module deliveries to project sites ahead of its April 2026 deadline to avoid potential tax-related price hikes. Now, with its expanded portfolio now including solar, battery energy storage systems, and energy efficiency solutions, SolarVest remains at the forefront of Malaysia's journey toward a 70% renewable energy capacity mix by 2050. Finally, wrapping it up with some major corporate developments and deals across Malaysia. AirAsia X Berhad targets $500 million to $600 million in debt restructuring after the budget airline this week bought the short-haul aviation business of Capital A Berhad. The next headline, Mega First Corporation Berhad is set to acquire an additional 12.5% stake in packaging film subsidiary Stenta Films Sdn Berhad for 33.1 million ringgit in cash. At number 3, the headline reads, FNN Holdings Berhad said it remained focused on building future value through innovation, diversification and transformation for the financial year 2026. At number 4, the headline is Marsing Group Berhad has opened a new ingress and egress ramp and toll plaza to Bestari Perdana along the Senai Desaru Expressway, a move expected to accelerate the growth of its 1,313-acre integrated township, Meriden East. Number 5, Nation Gate Holdings Berhad has been cleared by tax authorities, sending its shares to the highest in over 2 months. Next headline, DXN Holdings Berhad has signed a memorandum of understanding with Brazil's Apex Brazil as a potential regional hub for its Latin American operations, involving potential investments of about $50 million. And finally, Capital A Berhad's 93.5% owned logistics arm, Teleport Everywhere, has entered into a subscription agreement to issue $50 million in redeemable convertible perpetual securities to funds managed by HPS Investment Partners. That's a wrap for the Midday Roundup with me, Wanizul, on KleverStock. Thank you so much for choosing us, investors. Stay tuned for our upcoming live stream program and have a wonderful weekend ahead. And we'll see you soon.